Hey folks, welcome to another episode of Business Redefined, your weekly, most comprehensive look at the world of business, finance and economics. We began the year by having a conversation on the consumer banking landscape with Absa Bank. Now we want to flip the gears and talk about corporate investment banking with the same bank, that's Absa Bank, and we are privileged to have the managing principal in charge of that division, that's CIB, Corporate Investment Banking, Mr. JamesAgin. Karibu sana.
Thank you very much, Julian.
Thank you for hosting us this afternoon.
Yeah, you're welcome.
So James, let's start with the macros because that has been dominating conversation quite a bit in this market. The private sector, we have seen where interest rates are trending, where inflation is going, growth momentum as well. Where do you look at it vis-a-vis within the context of your CIB portfolio? What are your anticipations for 2025?
No, thanks, Julian, and you're spot on. I think the macro environment is evolving positively from that perspective. And just to touch on a few of them, I think the big one has been the interest rate environment. I think we've seen the interest rates come down very, very sharply. And for us, we expect that to stimulate economic activity in the country, especially for our corporate and investment banking customers, because naturally the borrowing rates then also come down in tandem and therefore stimulates the borrowing activity, which I must admit we had seen slow down, in 2024. I think what also helps with the macro environment is we are seeing an environment where there's predictability, especially in the exchange rates. I think the Kenya shilling exchange rate has remained fairly stable and consistent at a level where customers and clients can now price in an exchange rate in their businesses, the view that it will probably hold on in the medium term and therefore bring some form of predictability in that front. Inflation has also done extremely well. I think we've seen inflation at really low levels, and expectations that also comparatively then comes in and helps in a big way. And because of that, we are seeing an environment where with low interest rates, a very stable exchange rate, inflation at very low levels, ability for it to stimulate the economy, and we start seeing growth coming in, whether it's from consumer demand picking up, and that predictability, which for the customers we serve is a very, very critical component in the way they run their businesses, will also then enable them to now start picking up on investments and production that will then stimulate the economy. So very, very optimistic from a corporate and investment banking perspective.
James, even as you talk about predictability and what seems to be a very stable environment as of now, one of the wildcards as we look ahead into 2025 is the fact that Kenya's program with the fund is coming to an end, and the fund is the IMF. Yes. And there's been talk, are we getting a successor program? Are we not? How will that impact the macro environment? And everyone has been kept guessing, but we saw in the recent past, Kenya has gone back to market with a Eurobond. Had we been optimistic about IMF disbursement, highly unlikely would we be going back to market. How is that likely to change the landscape for you?
Yeah, I think for us, where that plays out is the role and how the international community then views Kenya and how that impacts the macros, depending on our debt sustainability and the fiscals that follows, with IMF support programs. So for us, it's something we're also watching very, very keenly. We remain very optimistic. I think we've seen the sentiment and the very positive sentiment that has come up, especially from the Eurobond buybacks. You saw the first one come through, the second one, and very successfully at that. And on the back of that, the pressures that previously we saw around what is the state of the sovereign, will the sovereign be able to carry through the maturities, that has kind of been deferred off. Now we know it's a deferral, but that indeed helps because it gives the sovereign then time to put in place measures that will then come in place to ensure that the debt sustainability is actually maintained. So on the back of that, we personally remain very optimistic about the support from the IMF. I think Kenya for a long time has actually played in very, very well in programs which are run by the IMF. We know there's a bit of a challenge in the previous year because of the finance bill issues, but on the back of that, I think there's a very clear understanding that the country still remains committed to working with the IMF to support them on the programs going through. And I think we saw indications that it might change the form of the programs instead of from direct lending to contingent, your kind of support. But that notwithstanding, we are of the view that there's still interest from the IMF to continue supporting. But what we've also seen is availability of liquidity to support the country in terms of funding sources. Yeah. I think we saw recently in the media some support coming in from the UAE in terms of lines that can be available. I think we saw the CS of Finance mention that it is there. for us to tap into as and when we need.
Yeah.
We saw the pricing, but I believe the pricing is just a reflection of the global interest rate environment that we're seeing. So from that perspective, I remain very optimistic that we should continue seeing support from the IMF, and should that take more time to negotiate, I believe that there's availability of liquidity globally to support, funding into the country in the current environment that we're in, where previous talks of sovereign default are now not being mentioned anymore, and there's a lot more confidence in the ability of the country to maintain its debt sustainability going forward.
I see.
Yeah.
Away from the macros, James, is the fact that under your portfolio, if I could call it, you have a whole raft of solutions: transactional, trade finance, debt as well.
Yes.
So when you look at the rear view in 2024, how did the various business lines perform? And when you look ahead, where are you expecting the thrust to come from?
Yeah, so in 2024, because of the high interest rate environment, I must admit that the debt side and the long-term borrowing kind of took a pause, because normally we use that to support expansions, entries into new business lines, etc. And because of that high interest rate, you'll find that the ability for a business to make returns after incurring that kind of financing costs was becoming a bit of a challenge. So we saw that side of the business kind of slow down, but what we saw remain resilient was on the trade finance side, because the business still need to run. So the working capital side of the business continued to flow. Demand kind of slowed down, but that notwithstanding, we saw letters of credit, short-term loans, working capital lines. In fact, because of the challenges in the global supply chain routing that was seen, where supplying and shipping took much longer to actually deliver, by extension, the working capital requirements of our customers became lengthened, and therefore the need for more working capital lines came through purely out of that logistics play that was becoming a global logistics challenge as goods moved from either Europe or from the Far East, etc. And because of that, we saw the working capital needs actually increase quite substantially. So on the back of that, trade finance and working capital went up in a big way. The long-term debt kind of slowed down, from that perspective. But we saw also areas like commercial property finance still remain very, very resilient. And, we got into new business areas like custody, which for a long time, we were the leading player many years ago. Disposed of that business, but as Absa, we've come back to being in custody, and we saw a lot of interest come through in that area too. But also our investment banking franchise, which we set up last year to have a fully fledged investment banking advisory business. We also now have a debt capital markets and equity capital markets business sitting out of Kenya, serving the East Africa region. We've also seen a lot more traction coming out of that side of the business. So that side of activity still continued, but the long-term debt part, we saw a slowdown on that just because of the pricing of the interest rates last year.
Allow me to pencil into two items you've mentioned there. One is your investment banking arm. So Absa comes into market at a time when, apart from 2024, which was quite bullish in the markets, this market has been in a bear run for a long time. We have actually seen investment banks consolidating because the volumes just are not there, unless you're dealing with the large ticket transactions.
Absolutely.
How is the takeoff for you?
Actually, Julius, the takeoff has been good.
Yeah.
Has been very good. We've gotten mandates which have actually made us feel it was the right investment to make. Because as you said, in an environment we're in last year, it actually got a lot of businesses to really rethink what is their next horizon of growth and how are they going to achieve that. Are they able to manage it on their own, or do they need to look for ways of consolidating, ways of getting out of certain areas and focusing on core competences, etc. And that's where this part of our business actually played a big role to play in. So we've seen instances of divestiture, which we had the privilege of actually being lead advisors on. We've seen instances of debt capital markets opportunities, equity capital markets opportunities, which have arisen out of this, for which we are quite privileged that we've been able to actually have roles and mandates in that area. So, interestingly, while the economy seemed to be kind of holding off last year, we saw opportunities to actually bring in these capital markets opportunities to help businesses actually think of their next horizons and guide them and advise them on how they can run that business going forward. And that actually turned out very, very well in that side of the business. So, and what this has helped us do is, by having boots on the ground in the investment banking business, it has brought us a lot more closer to what's happening in the market.
Yeah.
You'll find when you're dealing with a much more bigger investment banking business, then we always say what amount of deal size gets them out of bed.
Yeah.
But because you've got a team on the ground, you are able to then do much more smaller deals, which are much more prevalent in this market.
Yes,
but the
true.
team also supports the whole East Africa region. So that has made it a much more affordable outfit to have in the country, because they don't only look at Kenya, but they also look at Tanzania, Uganda, and any opportunities that will arise within the wider East African region. So because of that, we've seen a very good pickup of that, and we've seen them serve opportunities across the region, which has actually demonstrated it was long overdue, and we're quite happy that we are now in that space, which, in my view, was the missing link. Yeah, we were very, when the transactions were in the debt, when the risk management part of business from our global markets business, what we were missing was presence in the boardrooms of our customers.
Yeah.
And this has gotten us to now be able to have full visibility on end-to-end involvement in our customers' businesses.
Allow me to get back to the investment banking space, and I'm just curious, without giving away too much, how is your pipeline for 25 looking like?
Incredible. There are a lot of opportunities that are available in this market, because you see and you realize, over and above just the clients who are reviewing their whole capital structures and the industries they want to go into, the consolidations that are taking place, we also have a huge community of private equity players in this market.
Yeah.
And in the very nature of the private equity place, there's always exits, entries, and transactions taking place either between themselves or even into new companies where they're coming into play. And we are finding and realizing that that was a massive opportunity that we're just not playing in. But once we've gotten into that space, and the team that we put on board, we are realizing that they've opened that whole opportunity of business that we're not getting involved in, and yet that big ecosystem of the private equity place has a lot of transactions taking place every other day within that area. So now this again as a golden opportunity to either on the sell side or the buy side come in and play a role in that space, where the private equity player is doing one thing and we can always go on the other side, and vice versa, or even work with the private equity players in terms of their either entries or exits into investments that they've made previously. So again, a big opportunity there. So we are seeing the pipeline is actually quite impressive. The other thing we are doing as a Pan-African bank is bringing our customers in and out of the country and the region.
Yeah.
So you'll find there's a lot of Pan-African interest taking place, either East African companies going to other areas of the continent, and vice versa, where we have either Southern African countries, Western African businesses involved who are looking for opportunities in the Eastern African region. And our ability to walk them into this market, again, is providing us a lot of good opportunities to grow the investment banking business. So indeed, an area that we're very excited to be in, and what we've seen just in the last 1 year or so, when now the team has been fully formed, and we completed the formation of the team in Q4 last year, we've just seen the pipeline now starting to grow quite well because of just being closer to the ground and taking advantage of those opportunities that we didn't previously have.
Again, as you talk about the Pan-African footprint and the extent to which you are playing in the trade finance space,
Yes.
we are in an environment where we have seen a change of guard in the United States and a lot of tariff escalation so far coming from President Trump. What does that mean for trade finance? And not just for Absa, but by and large?
Yes, so Julian, that is a place, an area we are watching very carefully to see how does it pan out and what opportunities does it then present for Kenya and Africa at large, as the tariffs are being formed between other jurisdictions across the globe, but vice versa. With that trend that has started, what does that mean for Kenya and Africa at large in terms of the way those trade reset, for lack of a better word, will actually take place? As it is now, we've not seen direct impact where we've seen a retraction or a reduction. If anything, you look at things like AGOA. I mean, those are still in place. If anything, just going by the previous regime, when the current U.S. president was in power, was the president, we saw those areas actually do pretty well. So the view is that we may not be the targets as it is currently in terms of that, and if anything, probably we'll see those kind of trade agreements come more in line and actually flourish, because we also get a sense that there's also a lot of a drive to actually drive trade agreements between partners that the US can actually work with. But that notwithstanding, again, as those tariffs get formed within different geographies, we hope that there'll be countries turning into the continent of Africa to see if they can then replicate or replace what was done, or do business in a much more affordable manner within the African continent. So for us, we are very, very keen in making sure that we are ready to jump in and take care of opportunities when they arise. But also, it's also coming with an element of risk in terms of what will that do to exchange rates?
Yeah.
What will that do to interest rates? And so we have a team within the global markets area which does risk management solutions. And currently we are having a lot of conversations with our clients around risk management the solutions that we can offer. In fact, this week, interestingly, we are having 4 days of workshops with different sectors of the economy. This morning, we had it with financial institutions.
Yeah.
We'll be having it with importers, with exporters, with non-bank financial institutions, and just sharing with them what we see as opportunities, what we see as risks, and how through our risk management propositions, we can allow them and assist them to navigate those opportunities or risks and come out on top in an environment where there's a lot of uncertainty based on what's happening in the global macroeconomic space, as it were. So the geopolitics is something we are watching very keenly, but just making sure that we can assist our clients take advantage of any opportunities that arise and mitigate any risks that could arise out of that.
Again, when you spoke about investment banking, this market players in that space have been accused of being institutional investor focused.
Yeah.
No one really caters to the retail investor in terms of meeting their needs and helping them, because the products are quite sophisticated, whether it's ETFs, whether it's REITs, and the rest.
Correct.
How is Absa Investment Bank posturing in light of that?
Yeah. So within Absa, we've got a separate unit that is taking care of that, and that's the Absa Asset Management business. And the key focus of that is just to make sure that the retail consumer and the retail interests are actually taken care of from a solutioning perspective. So, whether it's money market funds, access to investment categories and classes which they would not be able to go in on their own, but allowing them, whether it's index-linked, returns they can get, access to portfolios of equities through, through fundings that are put together. Our Absa Asset Management business is actually well set and actually growing it's probably one of our fastest growing subsidiaries in that space. And all that was driven by the need to ensure that we're able to provide solutions for the retail sector in terms of investment opportunities. We just set up our wealth management and a business too that is also actively playing that. We've got our premier business and high net worth opportunities, which again our new colleague Sima D'Souza is running. And all that is to make sure that together with the Pan-African opportunities we are giving now the retail sector also opportunities to have investment categories and classes which they previously didn't have. And this is the whole spectrum of retail investors. So right from the high net worth to the likes of me who just want to access a fund that can get me a certain design of returns. And we've got the whole spectrum of those available. So our Absa Asset Management business is actively taking part of the retail segment of the business, while the corporate and investment banking business is taking care of now the institutional investor base, which you spoke about, which are expected to have their own analysis, their own ways of having a second view of what you're telling them and have a conversation and agree on a way forward. So all that is taken care of through the Absa Asset Management business for retail, and CIB investment banking for the corporate and institutional investors.
But again, seriously, what do you mean when you say from the high net worth to me? We know where you're placed. Pun intended.
Yes, I know what you mean.
Let's go back to debt. You did mention that last year in 2024, because of the interest rate environment, debt uptake was a bit lethargic. We have seen a correction, as it were, in the interest rates. But now we have seen supplementary budget 2 coming with outsized borrowing from the domestic market again. Yeah. And many of us are now worried that the softening we've enjoyed in the yields could easily reverse. I'm very curious as to your perspective.
I think there's a commitment by the government and the relevant agencies to keep the interest rates at affordable levels. And we've seen that drive coming through right from the government to the central bank, and in terms of a very, very intentional move to actually achieve that. And I think for me, what gives me comfort is that even if you look at the domestic debt market, first, we are starting to see increased levels of liquidity available, pursuing what is available in the domestic debt market, and therefore the prices are actually holding down. But if you look at what was also targeted as being the amounts which are being sought, you can see those have been achieved, and therefore, unless there's new incremental amounts which will be put through, we don't expect to see a lot more strain coming through on the domestic debt side in terms of a lot more issues that will come through. But that notwithstanding, if you just look at the amount of liquidity that has been available, pursuing those opportunities, again, I don't get a sense that there'll be pressure on the rates going up again, because there's a lot of liquidity in the market. And if anything, even we as the banks need to find a home for that liquidity. And that's why for us, lending opportunities into the private sector will be a good avenue to drive that liquidity going forward. So my take is, currently I don't see any pressure or any indications that show that we could have a reversal of the interest rates. I think they're going to stay in the current levels in the medium term.
I see. As we wrap up our conversation again, is that this market has now been described to be an environment which is a money market fund rush. Every other Kenyan you meet, we are pursuing an MMF in one way or another. And then when we saw yields coming down, many Kenyans were worried. What do you make of this MMF rush, if I could call it? Some have said there's a stronger case for collective investment schemes. We just need players like yourselves to structure products. And where do you think it takes the market in terms of inclusivity of our capital market structure?
Yeah, very, very good question, because it is something even we as a bank are actively looking to solution. One is providing different investment classes for people to invest in and to increase the savings, because as you know, what we've said in this country, the savings levels are still low, and we need to incentivize and make people be willing to save more, but also give them different savings opportunities for which they can then diversify their savings holdings. I mean, if you look at things like the gold ETF, for example, which we are proud that Absa was a leading player in bringing in the gold ETF, that was just giving, again, clients a different opportunity, a different asset class for them to be able to invest in and not have to be an institutional investor, because you can invest in that as a retail investor and just buy the level that you actually want. But totally aligned with you that there's a need to continue bringing in packaged investment products that allow people to then invest in different categories that give them different risk profiles. So whether it's driving for the REITs market to actually, increase, even the money market funds, packaging different types of underlying, asset classes to go there, whether it's an equities one, whether it's even one that is indexed to a foreign, exchange, as it were, or local money market funds, local equity funds, etc. I think for me that's an important part that the banks have to play. And to the point that you raise, how do we then make this tradable in the securities exchange to just increase the deepening and to give also the wider population the comfort of knowing that there's a lot of governance structures wrapped around it through the governance structure of having things listed on the securities exchange. And for us as a bank, we've got our Absa Securities Limited, which again has our investment banking license, but again, actively playing in bringing in different types of exchange traded funds to be launched into the market this year. We're also working on launching another one into this market. And we are very, very clear that as Absa, we want to play a leading role in driving the financial sector deepening through provision of more exchange-traded funds to give our client base and the wider population a much more diversified base of asset classes which they can invest in. But fully aligned with you on that we do also have a big role to play in that financial sector deepening and investment class deepening that is needed to increase the savings that are available in the market, as it were.
Now I'm curious again, when is that ETF going to market?
Well, the governance licensing is something that I think we're actually at the tail end of it. And once that comes into place, I see that as end of this quarter, latest quarter two, early quarter two, it should be in the market. Yeah, we've gone through the whole governance process and we've gotten a lot of support from all regulators involved in it to launch it in the market to just, because what we see is that that interest is across the board. Everybody's really, really very supportive in ensuring that there are more instruments available. So if not end of this quarter, latest early quarter two, we should have it already in the market.
Wonderful. And you had it first here on Business Redefined. As always, breaking the news in the corporate action space. We have been privileged to be sitting down with JamesAgin, the managing principal in charge of CIB at Absa Bank, on a raft of issues from the macros to interest rates. We have come now to discuss the capital markets and what the pathways ahead look like for 2025. Stay tuned for more updates as they develop.